Good morning, everybody. As part of our continuing education, I have my good friend and personal accountant, by the way, very happy with her services. And she's going to talk to you today about some very important things for real estate investors to understand. And we'll also get into what to do with your K1, because you're all going to be getting K1s and maybe some of you for the first time. So welcome, Jamie. Appreciate you taking the time.
Thanks, Trevor. Thanks for having me. We do get, obviously we specialize in real estate accounting and entity structuring, and we get a lot of questions after the fact, really, from investors when they do receive their K1s in terms of, well, what's deductible, what's not deductible, what is actually taxable. You may have gotten a cash out refi or property sold, or you're just getting regular earnings that are coming through that you're getting distributions on from some of these investments. And we want to know beforehand what's going to be taxable and what may be kind of kicking that tax can down the road. So let me share my screen. I have a quick little presentation. I'm going to go through some general terms, just some basic information on real estate investing. And then I know this one's kind of more on the passive side. So then we'll get into that and look at a K1 and see how all that flows through to our personal taxes.
Awesome. We appreciate your time, and go ahead and share your screen and get going. I don't see it right now.
We don't see it yet?
Not yet.
Oh.
There. Awesome. It's coming up. Very good.
Perfect. So a little bit about me and our firm.
And I think we started a little further along. You might want to back up because I'm on the comprehensive financial planning chart. Yeah. One more even.
There we go.
There we go.
So like I said, today we'll focus more on tax planning for the real estate investor and how all of that pulls together. Optimal Financial Group started about 15 years ago in Virginia. My partner at the time, Charlie Dombeck, actually started the firm, and I came to work for him as a young accountant. Since then, I have taken over. First, I took over as managing partner about 8 years ago, and then I recently purchased out the rest of his share of the firm this past year. So last year was a busy and exciting and a little bit scary year for me, but we are full scale now. We do focus a lot on the real estate professional. I'm a real estate investor myself, so that's kind of where my passion is and how I got into a lot of these passive groups and met Trevor at some coaching events and networking events. We do focus a lot on the tax mitigation, the entity structuring side, making sure that our clients know from a tax perspective what they're getting into and that they really understand it, because honestly, the more that our clients understand, the easier it makes our job as well. So we focus on asset protection, wealth accumulation, asset management, making sure that there's an estate plan in effect. We don't actually do the estate planning side of it. We're not attorneys, but we do have a wonderful network of professionals that we work with to make sure that all of our clients have a comprehensive plan. Again, not a lawyer, so I'm not giving legal advice, but I have been in this field for about 15 years now. So I've pretty much seen everything in terms of real estate investing and different structures and how all of that, all the different planning as the market changes, how all of that takes effect. In terms of entity structuring, it really depends on what type of business you're in. There's no real cookie cutter model on what type of entity structure you should have. So some clients will have a LP, some will have an LLC, some will have a C corporation, depending on what kind of planning they went through and how they come to us. But it really is dependent on your personal, where you are personally in your financial life in terms of what makes sense for you. So we take a look at everything to make sure that you're taxed at the lowest possible rate and that you're protected. One of the big things that we look at in terms of our real estate clients is what's best for you. Like I said, there's no cookie cutter model. It depends on if you're an investor or if you're a dealer, if you are active and passive, or both. So you can have both and still have different type of entities that fit into your financial life and platform. Investors, as most of our clients and investors in some of these groups know, they're going to be more for the long term, right? And you can be passive or active in terms of your long-term investing. Do you hold rental properties, or are you more into the passive syndications? Where does that fit into your life? Some do owner financing, or just even notes. For dealers, we're going to look at more of the active base. So you have your short-term focus, your fix and flips. If you're doing any kind of assignments or wholesales, that's going to be the active based and dealer status. And all of these, if you have other questions that factor into it, we're just kind of going over the terminology right now. But if you have specific questions in terms of whether you're dealer or whether you're passive and what type of entities you should have that fit into your financial life, then we can definitely have a one-on-one meeting on that. Tax comparisons and why it matters if you're a dealer or investor. From a tax standpoint, if you're a dealer, it's going to be a higher tax rate. So you're going to get hit with ordinary income taxes. It's considered active, which means that there could be self-employment taxes that you're going to pay. That's going to be the 15.3% Social Security and Medicare tax that you're going to pay on top of your ordinary income. And the max tax rate on just the ordinary is 37%. When we look at investor status, it's a much preferred tax rate. You have your capital gains, which is a maximum of 23.8%. Really, it's 20%, but if you're above a certain income level, you have that 3.8% Medicare surcharge that's added into that. It's considered passive in general, so you don't have those self-employment taxes, so it's exempt from that side of it. So it's a much more favorable tax bracket on the investor side. We get a lot of questions in terms of, okay, well, I'm a passive investor, or maybe I have rental properties and I actively participate in them. And how can I benefit from all of these depreciation write-offs or losses that I have, even though we may be cash flowing, but how do I benefit from these losses? And the only way that you can really benefit from losses on real estate is if you qualify as a real estate professional. That real estate professional status, there's three main qualifications that you have to meet. One is that it's over 50% of your working time has to be in real estate. So if we have a W-2 job, it's pretty difficult to meet that hurdle unless we're kind of working part-time. But if it's a higher earning W-2 job, for it to pass the smell test for the IRS, it's going to be difficult. And you can probably expect an audit if you're claiming full-time real estate professional with a high earning W-2. The second qualification is that it's got to be more than 750 hours of your working, 750 hours working in real estate related activities. So this could be anything with real estate. You could be an agent, you could be a real estate broker, you can do construction, you can be doing networking events, coaching, education, your due diligence, all of that qualifies in the 750 hours bracket. And then of that, 500 have to be material participation. And this is the one that's a little bit tougher to prove. This is more hands-on. So if we are just in syndications, even though we may spend a ridiculous amount of time doing our due diligence, which is awesome, we could meet that 750 hours. But unless we are hands-on within a real estate business, meaning that you purchased the rentals already and you're managing them and you're doing the rehabs and you're working on them, or if you are in a true real estate business, meaning a broker, a construction company, anything that's really hands-on, that will qualify for the 500 hours. So that one's a little bit harder to meet unless we are a true full-time real estate professional. With that, what it allows us to do, and the main benefit of the real estate professional status, is it allows us to claim all of our passive losses against our active income. So let's say my husband, if he was not working, and I obviously own the accounting firm, if he's not working, but we have 20 rental properties and we have some syndications that we're passive investors in, and let's say he works part-time or doesn't work at all, if he qualifies as this real estate professional, all of the losses that are coming from the rental property depreciation and even from the passive syndications would offset my W-2 income, which could be a huge tax savings. It also takes away that 3.8% investment income tax for the net investment income tax. So if we can qualify as a real estate professional, it's definitely beneficial from a tax standpoint. And here's just a really quick example on that. Kind of like I said, if I'm a W-2 employee and we have some rentals that are creating $16,000 in losses, a K-1 syndication that's passing through $8,500 in losses, we can have a tax savings from that real estate professional election of close to $5,400. So as you can see, and this is a lower example, but this can be quite beneficial if you have a savvy accountant that goes through those questions with you and you qualify. So that's kind of just some general quick real estate terminology that we go through. And again, if you have any questions, you can always reach out to me in terms of anything that you saw that kind of rings a bell specifically with you. But now we're going to go more into our passive investing, our syndications, where we want to be kind of completely hands off, don't really want to deal with the day-to-days, and allows us to still create some cash flow. Some main benefits of passive investing or syndication investing is we can have current income coming in, whether it's monthly distributions or quarterly distributions or lump sums. Maybe we have a cash out refinance or a sale of a property. We have that passive income coming in that may not be taxable to you. Generally with that, and our only exposure as a limited partner is what we committed to the project. So if we put $100,000 in, our only exposure is our $100,000 investment. We're not going to lose more than that if something were to happen. If there's a lawsuit against the syndication, anything that would come up, our only exposure is what we initially put in. There's some great potential for high rewards with that limited exposure. I have seen, and I wish I had been in some of these investments coming from me seeing the K1 side of it, but I have seen some investments that come back where, clients have put in $100,000 and at the end of it, they're getting $250,000 to $300,000 back. So they're, with the market the way it was the past couple of years, I've seen some crazy returns come through. It's completely passive. So you're not going to have those tenant and toilet problems. We're not going to get a call at 3 a.m. that something seriously happened at one of our properties that we have to deal with. It's completely passive. You're not going to hear anything other than possibly getting, quarterly financials that you want to review. As limited partners, you're able to limit the day-to-day involvement in the projects. Your general partner is going to deal with all of that. It allows us to eventually generate passive income while focusing on our other businesses or our family or whatever stage we are in our life where we don't want to deal with day-to-day business activities on rental properties. Depending on the operating agreement, distributions are typically tax-free distributions as they're considered return of capital. So you could get, let's say, $20,000 in distributions on an annual basis from a $100,000 investment from cash flow that's coming through, and you're likely not going to have any tax impact on that because depreciation is going to help offset your true taxable income from the property, even though you're cash flowing. It allows us the ability to diversify with a partnership or a syndication. Most of the time, they're able to buy larger properties or more properties as a group than as an individual investor typically can. So it's a great way to diversify the portfolio. We also have a value-added asset that when it gets sold in a hot market like we've seen can be huge, like I said. Now, there are some potential pitfalls, obviously, with any type of investment. It is a private partnership, so investment typically lasts for several years. You can't just cash out whenever you want to get your money back. So it could remain illiquid for the durability of or the duration of the partnership. It's only going to be as good as the general partner or partners who manage it. So make sure you do your due diligence. There are some great syndications out there, some general partners that have been in the game for a long time and have proven track records. We want to make sure that you're doing your due diligence and make sure that you're comfortable with the investment and with the general partners. Another pitfall is that timing is beyond your control. So although real estate investments typically perform well over the long term, the timing of an investment and how it fits into what the market is doing is important. So we may come into an investment thinking that it's a 5-year lockdown, but then the market changes and it doesn't make sense to sell that property or go into another 1031 exchange. So they may hold on to it for a few more years. So those are just some things to think about when you're getting into more of a private partnership versus buying personally. The taxation side, which is really why we're here, how this all flows through. We have a Form 1065 that's filed at the partnership level. That's going to pass through the limited partner and general partner's income and losses on a K1, which is then reported on your personal return. So if you're new to this type of investing, you're going to want to make sure that you have that K1 before you file your personal tax return. Otherwise, you're going to have to amend it when you do receive it. And K1s, they typically have until March 15th to file the partnership tax return. And then if they extend, they have until September 15th. So you could be holding on to your tax return filing until after that 7/15 or that 9/15 deadline, just depending on when the K1s are provided to you. But most syndications that I've seen actually get it out before that March 15th deadline, unless they're doing a cost segregation study or something like that, where they have to push it out a little bit. If there is net taxable income reporting on your K1, there's a possible QBI 20% deduction. So that's another benefit, is that with QBI, this was a new Tax and Job Act from that 2017 act that came through, where it allows a 20% deduction of your taxable income from a qualified business to offset your overall taxable income. So that could be a small added benefit to you as well. You are, as we stated, generating that passive income at lower, more favorable tax rates, because the maximum that you're going to pay on any capital gains, as we said, is 23.8%. If we do have rental income passing through to you, if we already utilized the depreciation above what our cash flow typically is going to be, then that would be at your ordinary tax bracket. So whatever your ordinary tax bracket is what the box 2 on the K1 would show from the rental income. If you have losses, those will likely carry forward to future years if you do not qualify as a real estate professional and you're not actively participating. When we do have sales of these capital assets, those prior passive losses that we have accumulated over the years will and can offset the capital gains from a sale of a property. It could also offset other capital gains that you may have. So these losses could, even though you're not a real estate professional, they could still benefit you on an annual basis if you have other capital gains that they can offset. They would not offset W-2 income, interest income, dividends, or any business type income. But if you have other passive capital losses or capital gains, these losses would offset them. So it's a great planning tool, especially if we're looking at truly being passive. It allows us, like I said, to kind of kick that tax can down the road. If you are looking at investing and you do know that you have some large gains in a year, and you're looking at investing in other syndications going forward, and you want to make sure that you do get the benefit of write-offs, you want to make sure that you're trying to find syndications that are going to do cost segregation studies, because that's going to allow them to write off a much larger amount of the depreciation on the assets in the initial years. So that's where you see, if you get a K1 and let's say we put in $100,000 and we have a K1 coming back that's showing a $60,000 loss. They likely did a cost segregation study that's showing a large amount of depreciation that's passing through to you. A quick K1 example, and this is kind of where I was talking about. You see this number 2 box that shows the net rental real estate income loss. This is showing about a $68,000 loss. We see here that this investor put $100,000 into this LLC investment, and they received $1,008 in distributions. So this $1,008 in distributions is completely not taxable to them. Whatever you see in this box 19 is going to be non-taxable to you unless this capital account here is negative. If this capital account here is negative and you don't have debt to offset it, then you could get into partner distributions in excess of basis. So that's something a little more complicated, but always look at this bottom line ending capital account, because if it is negative, you could have a tax impact there. But normally whatever debt they have increases your actual basis, which would offset that. So if let's say we're a W-2 employee with no true active participation in real estate, and obviously no active participation if we're an LP in a syndication, this is really going to have zero tax benefit to us just looking at this on the face. Like I said, if we do have other capital events that are creating capital gains, then we would have some benefit from this where it would offset those other capital gains. But if this is our only investment and we did not have any prior year, we don't have any prior year investments that are going to sell, then this passive loss will carry forward on our tax return indefinitely to offset future passive income. So if this number 2 box was ever positive, these prior losses would offset that in the current year. And then if this property were to sell in the future, whatever losses that accumulated here would offset that income in the future. So let's think about it this way. If this investment were to sell next year for 200,000, if your capital that you received back was 200,000, you're going to have a 200,000 capital gains here in your long-term capital gains. You would show 200,000 as your gain. This 67,000 is going to offset that capital gains amount. So you could get cash in your pocket of 200,000, but you're only going to pay tax on 130,000. So it can help in terms of future planning. And then if we're able to push that investment into another syndication, where let's say we put that total 200,000 into another syndication and they do a cost seg and allow you depreciation, we could fully defer that tax until we fully close out of all of our passive investments. So like I said, it's a great way to kick that tax can down the road for a while. What I like to think of these as is it's more with my passive investments and syndications. To me, it's more kind of retirement plan, right? Obviously, we have our 401ks and things like that, but we all know how the stock market's doing these days. So to me, it's more of my long-term retirement plan. I'm going to continue not paying tax. I mean, obviously, I paid tax on the original amount that I contributed because that was an after-tax contribution. But I'm going to continue to invest even once my properties sell, even once these partnerships close down. I'm going to continue to invest that into new ones because it's continuing to grow with appreciation. And hopefully, my tax bracket when I retire, or the plan is my tax bracket when I retire will be much lower, and those capital gains at that point will be a much lower tax hit. We won't really go into 1031 exchanges, but it's just something to think about. You can't do a 1031 exchange from one partnership interest into another partnership interest, but at the partnership level, if a syndicator wanted to sell one property and do a 1031 exchange inside that same partnership, that could also work in terms of deferring tax. So that's something to think about. And if you have questions on that in terms of, well, my syndicator wants to do this, is this going to be a good idea? We're welcome to go through any of those questions with you. But that's another way to defer that tax liability, is doing a 1031 exchange. Just some general recommendations to think about. Remember that income taxation is a controllable cost. As long as you have that planning in place throughout the year, make sure that whoever you're speaking to in terms of, your planning and your tax advisors, make sure that as you're making what we call money moves, that you're reaching out and letting them know and doing any planning throughout the year, because it's really hard for us to help you in March or April when you come for taxes. It's really hard to help at that point when we could have been helping throughout the year. Make sure you fit entities in your financial life. And that's, as I said, it's no cookie cutter model. It really is dependent on your personal situation and what your short and long-term goals are. And again, like I said, I can't hit on this enough. Make sure that you constantly plan throughout the year, because that's really where we get the most bang for our buck, is making sure that there aren't any huge tax surprises and that we are able to control that throughout the year. Here is my contact information. You can reach out. Email is the easiest way to reach out, or you can click on the Calendar link and set up an initial consultation. We do consultations. The first one free of charge, just to get to know you a little bit and see if we're a good fit for you and that you're a good fit for us. So if you do have any questions based on the presentation or just not sure how the syndications could work for you, definitely reach out and get on the calendar. We are obviously coming into tax season, so that calendar is kind of limited at this point. But if you have a quick question, email is probably going to be your best bet.
Awesome. This was fantastic. Thank you so much. And I'll include contact information as well. And obviously this is a very complicated topic, and this was designed to give you a big overview. And when you have more specific questions, you can reach out and talk with Jamie or talk to your current accountant. The one thing I find though is a lot of people that have accountants, they really don't understand the real estate niche. They really don't. And so many financial planners, advisors, and even accountants do not understand it. And I can't recommend enough that you get an accountant that understands real estate investing if you plan to be a real estate investor, because it's such a powerful vehicle, not only to earn money, but to save on your taxes. It really is. So awesome. Well, I want to thank you so much, Jamie. And again, I'm going to provide, hopefully you don't get too inundated, but I do highly recommend that you contact someone again that knows about this particular topic. So it's very important. And any questions, you can always still reach out to me. As you all know, my goal is for 1,000 people to reach financial independence through real estate investing. That's a lofty goal, but I want to do that through educating and providing resources that you can understand something that is very unique. So again, I want to say thank you, Jamie, very much. I appreciate it. I know you're going on vacation, so enjoy your vacation. I know you need one probably before tax season.
Yes. Thank you for having me. It's been a pleasure anytime.
Awesome. Thank you so much. Thank you.